Ever wondered why money gets deducted before it reaches your account? Or why sellers collect extra tax on certain purchases? Let's understand the basic meaning of TDS, TCS, and ITR in under 2 minutes. First, TDS, tax deducted at source. TDS is tax deducted by the person or organization making certain specified payments such as salary, interest, professional fees, etc. at the applicable rate and deposited with the government on your behalf. For example, suppose your salary is 2 lakh and your employer deducts 25,000 as TDS, you receive 1.75 lakh after the TDS deduction, and the 25,000 is then deposited with the government. The employer also reports the TDS to the income tax department through a TDS return. Next, TCS, tax collected at source. TCS is tax collected by the seller from buyer on certain specified transactions at the applicable rate. For example, TCS may apply to certain overseas tour packages, high-value motor vehicles, and other specified goods or transactions such as coal, iron ore, timber, tender leaves, alcoholic liquor for human consumption, etc. For instance, if you purchase a car worth 20 lakh and TCS is applicable at 1%, the seller would collect 20,000 as TCS from you, along with the applicable purchase amount. The seller then deposits the TCS collected with the government. Can you get your TDS and TCS amount back? Yes, any excess TDS and TCS can generally be claimed as a refund. TDS and TCS are amounts of tax deducted or collected during the year. If the total tax already paid is more than your actual tax liability, you can claim the excess amount as a refund while filing your ITR.
Example. Suppose your total tax liability for the year is $50,000, but $65,000 has already been paid through TDS and TCS. That means you have paid $15,000 more than your actual tax liability. When you file your ITR, you can claim this $15,000 as a refund, subject to the applicable tax calculations. So how do you claim that refund? By filing your income tax return, ITR. An ITR is a form in which you report your income earned during the previous financial year, which runs from 1st April to 31st March, along with your total income, eligible deductions and exemptions, taxes already paid, such as TDS, TCS, and advance tax, your final tax liability or refund due. You file the return with the income tax department. Filing an ITR can also help you claim eligible refunds, maintain compliance with tax laws, and provide income documentation for purposes such as loans, visas, and other financial requirements. When do you file an ITR? An ITR is generally filed after the end of financial year, and the year in which that income is reported and assessed is called the assessment year, AY. The return must be filed within the applicable due date prescribed by the income tax department. For example, the financial year F 2025-26 runs from 1st April 2025 to 31st March 2026. The ITR for income earned during this financial year is filed after 31st March 2026 in the assessment year AY 2026-27. So right now, it's ITR filing season for reporting the income you earned during the previous financial year 2025-26. There are different types of ITR forms, and which form you need to file depends on your income, sources of income, and taxpayer category. The due date can also vary. One more thing. From 1st April 2026, the new tax law introduces the term tax year and removes the separate concept of assessment year. So, for income earned from 1st April 2026 to 31st March 2027, the relevant period will be called tax year 2026-27. I've pinned the link explaining the different types of ITR forms and their due dates in the comments below. Check it out. If you found this helpful, don't forget to like, share, and subscribe to Tax Clarity for more simple tax concepts.